stock markets definitely liked Microsoft and they definitely liked Meta earnings, but they definitely didn't like Amazon's and they definitely didn't like Apple's. And where are we left with the S&P 500? Well, not very much of anywhere, as macro risk once again appears unvarnished ahead of us. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to take a look at how this very jumpy week for financial markets might end in a loud crescendo with the release of U.S. jobs data. This is a very interesting moment here for the markets. So what we are going to do here is, first and foremost, unpack a little bit, do a little bit of autopsy on the price action over the past 24 hours here, because it is worth looking at exactly what the markets are doing and why they're doing it, and then look ahead to this jobs data and see how that might fit into what could be an explosive end to the week. So let's take a look here at what's going on. This is a chart of the S&P 500 here, the continuous ES contract. It's pointedly not including the overnight action here. If we take a look at what's going on overnight here, we actually do have a little bit of sogginess in the wake of the announcements from Microsoft, or from Amazon rather, and from Apple. Those pieces of guidance were not to the market's liking, and if we look at where we are here on ES, we're down about 0.5%. On NASDAQ, we're down about 0.7%. But the upshot is not dissimilar from what we're looking at here. And what we find is that the markets over the past 48 hours, essentially, have erased what was the post-Liberation Day kerfuffle. So if this part of the market decline from mid to late February and into the beginning to middle of March was about business and consumer confidence surveys starting to show that worries about implementation of fiscal policy, mainly the tariffs, of course, has become a dampener on economic activity, then this right here, this wild gap and the subsequent panic sell-off, was that Liberation Day announcement that basically suggested initially at first blush that the U.S. was determined to wholly take apart the post-war trading order, post-World War II trading order that it itself engineered and built. And that, of course, raised all kinds of existential level concerns. And since then, when we started to walk that back with the pause in the sort of most biting part of the reciprocal tariffs, everything above 10%, it looked like the market unclenched. There was a secondary fear around maybe the president would move to try to extrajudicially fire Jerome Powell, the chairman of the Fed. That unclenched once the president dismissed that he was intending to do that. And we seem to have come out of whatever this kind of hair on fire episode was. And where we've been left is a very interesting spot, because we are right back to where we were before Liberation Day and back into a mode where the decline was driven by a view of the business cycle. And the concern was that what this fiscal policy fog will do, and was already doing, was hampering economic activity And what that would mean is recession. We got a preview of this yesterday. You can see it in this seesaw here. At one point, the S&P was down 2.2%. That's this long wick right here. And you can see where that long wick is. This is now a 15-minute chart of the price action. Again, it doesn't show this sell-off that we're now seeing around the Amazon and Apple earnings. But what you see is here's U.S. GDP data that comes out yesterday. And here's where the Microsoft and Meta earnings come out. And they're obviously greeted with positivity. This GDP number is clearly something that gives the market indigestion. It spikes lower, but then resets to basically unchanged. That's this green bar here. Into the close before these announcements. And of course, investors are rewarded for not wanting to lean in on the downside with this event risk ahead of them, as we argued yesterday, because ultimately the numbers are something that turns out relatively good. And there's a pop. But do we actually go anywhere since then? Not really. We get a little bit of a sign of life around the cash equity open, but that's really it. Ultimately, the markets don't do anything with this other than the one-off response to the event risk. And if now Microsoft and Meta and Amazon and Apple, if all of these names are now out of the way, and now the next thing that we need to think about is macro data and the business cycle in isolation, well then what have we set us up for? Tomorrow's earnings offerings are not these mega cap names. Exxon, Chevron, Cigna, Apollo. These are kind of the big announcements tomorrow. And all of them are due in the AM, so there's no big after close PM risk. So as we consider then what comes next, let's take a look at why the markets got so unnerved by GDP. Because it looks like this is the part of the story that's front and center from here into the end of the week. Well, we saw that GDP contracted, down for the first time in 3 years. The last time was in the first quarter of 2022. That was a decline of 1%. This was a decline that was more modest, 0.3%. But of course, it surprised. The expectation was that we'd get the same magnitude, but on the upside, that we'd get a 0.3% increase. That's not what we ended up with, clearly. And the market didn't like that it was negative, sure. And then, as we saw, we got this bounce. And to be sure, there is a lot to be said, again, in my opinion, for not wanting to have directional conviction before these big announcements. But you certainly heard a lot made of the argument that this is not really as bad as it is, and flagged the internals of the report. And rightly so. You take a look at those internals, we can see here that a huge detractor to GDP came from a surge in imports. The way GDP is calculated is you get consumption, add investment, add government spending, add net exports. That is exports minus imports. And clearly, this dramatic surge in imports made the net exports component here, green part minus the brown, a huge downward influence. If we consider, by the way, the downward influence from the Doge government spending cuts is barely a sliver about a quarter of a percentage point of overall GDP. But this imports downdraft, it's a huge influence. And it is offset to some extent by a giant jump in investment. So what is this all about? Well, quite clearly, as the PMIs both from the US and China have been telling us for months, there has been a rapid attempt to front run the tariffs. Because anybody that's been paying attention since November at the absolute latest knows that the Trump administration had tariffs on the menu. People didn't know what kind of tariffs, how they'd get rolled out. But tariffs were a huge part of the president's campaign. So when he won in November, one might surmise that everybody rightly knew that the tariffs were coming. And businesses, reasonably enough, rushed to stock up inventories at the lower rates as quickly as they could. And even though the tariffs, in particular facing China, didn't get much of an unclenching, we nevertheless have had a gradual increase in them. So it has paid for months to buy as much as one can from China because tariffs on it have only gone up. So any purchases made between now and, let's say, the beginning of the year, all of them have faced incrementally higher tariffs the longer you waited. And the PMIs have shown us this dramatic burst in activity to try to stock up and front run still higher import taxes. And you see it here in spades with this dramatic surge in imports, but also this dramatic surge in investment, because what this shows you is the buildup of inventories that this surge is feeding. And what all of this then suggests is, well, look, we have this giant thing from imports, we have a giant thing from investment. None of them look anything like any of the recent past. All of this is noise, and the imports are clearly outweighing everything. This is not a GDP number to worry about. Makes sense that markets shrugged it off. Okay, maybe so. But that's hardly the story in these GDP numbers. Take all of this noise aside and look to consumption. Why consumption? Well, because when we look at the breakdown of GDP going all the way back, all the way to the start of the post-war period here, this is 1950 here. Consumption hovers somewhere between 60 and 80% of GDP. Government spending, down here. Not even 20%. Never mind exports and imports, which barely register. When you net them out, they come out to a contribution of less than 4.5% of the overall. And what do you see on consumption? On consumption, you see the smallest contribution to overall GDP since back here, the second quarter of 2023. So what we end up with is, for the biggest component of GDP growth, 68.5% of it, we have the weakest contribution in almost 2 years. Looked at in terms of growth rates, we can see exports are meager, but imports absolutely surge in terms of their growth. Inventories surge in terms of their growth. Consumption is the weakest annualized growth rate, again, in almost 2 years. That's the real story in these GDP numbers. And if we are, in fact, going back to a market that's more concerned with growth than it is with some sort of a sovereign kerfuffle, well, then it's important to note that none of the growth concern here has been undone. All we've done is had a panic and then come to our senses. But the GDP numbers are telling us that what inspired this is very much afoot and has now been confirmed in hard data. Which, of course, brings us to the major event risk in front of investors now with no earnings fog to distract them. And that's the US NFP report. The expectation is that the economy is going to add 130,000 jobs in April. That'll be a little bit of a climb down from the 228,000 that it added in the prior month. The unemployment rate is seen holding unchanged at 4.2%. If we look at the way U.S. economic data has performed relative to forecasts, the data from Citigroup here that we like to follow, it suggests that we are underneath this zero line here, which implies that U.S. data is tending to undershoot, albeit not by a huge margin, but to undershoot relative to expectations. And that, to some extent, sets the stage for a downside surprise because it implies that economists' models of the economy are giving them forecasts that are tending to be rosier than reality is validating at this moment. And because of that, whatever forecast we have on the board, in this case 130,000 jobs added, might well fall into the pattern. Now, there is a bunch of incidental data, not even including the disappointing jobs report from ADP this week, which is a very inconsistent sort of lead for NFP. We do have a bunch of leading data that would suggest that indeed there is weakness to be seen in the jobs market. First of all, we get the ISM manufacturing survey, and of course this operates as PMIs do, with a center line at 50, where that's neutral. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what we see is a second consecutive month of contraction. We see the pace of contraction accelerates. So this most recent yellow bar is both lower and longer than the one before it. Moreover, new orders shrinking and employment shrinking for a third month. Now, the pace of contraction for both eased a little bit, but nevertheless, a third consecutive month of contracting employment is hardly good news. And for what it's worth, on the inflation side of things, costs for manufacturers are absolutely skyrocketing and started to move up at a higher rate in this survey. But for us, with NFP in front of us, the key is the employment side of things. And the main takeaway here is that for a third consecutive month, manufacturing employment fell. We likewise see from a separate PMI survey that was finalized today from S&P Global, the worst manufacturing job creation figures in 7 months. So there is, in fact, some indication that April was a bad month for jobs growth. It's not dissimilar from the picture we get in jobless claims figures. And perhaps most worryingly, not only do we get a pop in initial claims, so new applications for unemployment benefits, that's already something of an issue, but It's hardly the main or the scariest. The bigger issue is this jump in continuing claims. In fact, continuing claims here actually end up at the highest level since November of 2021. And that tells a very worrying story, because what that implies is not only are people being laid off, but there has been a level change in how quickly they are able to find new work. And what this surge implies is that they are increasingly struggling to find it. Now, if all of this translates into a weak jobs report, well, then what is the upshot? Well, if stocks are focused primarily on growth from here onward, and we're essentially back into this mode here, then signs of economic weakness mark this as perhaps the end of this rebound and a re-engagement of whatever this trend was, reflecting incoming recession risk. It also probably means that the markets are going to start to hope that next week the Fed is going to do something about this, and perhaps end up in more dovish Fed policy expectations. As it stands here, the markets are pricing in 128 basis points in rate cuts between this year and next, and we can see they're front-loaded here. 86 basis points expected for this year. That's at least 3 rate cuts, with about a 50-50 shot at a fourth. Next year, we're looking at least 1 cut, but with a heavy probability towards 2. 42 basis points out of 50 basis points, that would be 2 cuts baked in. At 128 basis points total, that gives us 5 cuts. So 1 extra than the Fed has been projecting in December and in March. And so the market is already somewhat tilted to a more dovish direction. And the question would be, if the jobs numbers disappoint, how much do they disappoint by, and does that change the Fed's calculus? Because the Fed has been resistant to doing anything quickly, largely around the same kind of uncertainty that businesses and consumers feel vis-a-vis the tariffs. The Fed does not want to make a decision amid so much uncertainty, because its decisions are longer lasting, have significant runway after they are made. It can take between 12 to 18 months for a single Fed policy change to be fully absorbed into the economy. So what we're looking at then is a kind of U-shaped response function to what the number might be. If the number is abysmally bad, if it's shockingly negative or some such thing, one might reason that the Fed would then be seen as likely to perceive an emergency, could cut rates as soon as next week, if that kind of an emergency were on the table. Likewise, if the markets were to get a positive surprise, well, then perhaps the markets would go, you know what, there really isn't a growth scare here, and there's not much to get all upset about. Yes, the numbers are hot. Yes, that probably means the Fed isn't going to be in a hurry to cut, but that's all fine because the growth scare doesn't have much teeth in it. Let's wait and see. But if the numbers are soggy, and if they're, as we suspect, lower than expected, but not terribly so, well, then you get the worst of all worlds. Because then the Fed is not in a hurry to cut, but the cyclical risk is very much afoot. And the response then may well be a pricing in of more easing later downwind, which could mean, aside from a stock sell-off, that this pullback in the long end of the bond structure, this is the 30-year note, finds itself some support around this inflection point near 115 and begins the next leg higher. So the upshot could well be weaker stocks, lower yields, stronger bonds, and against that backdrop, perhaps a weaker dollar. And that is macro money for today. We are here Monday through Thursday, so this is our last show for the week. We'll be back next week, of course. I am likewise on Futures Power Hour, both tomorrow, Fridays, and Mondays, on the price of truth with Victor Jones on Tuesdays, as well as with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money, we'll see you next week. Good luck.